My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramer. Other people want to make friends. I'm just trying to make you some money. My job is to just entertain, but to educate and teach you. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. I hate to say it, but I think the buyers are getting complacent in this market. They know nothing. After a day where the Dow gained 45 points, S&P advanced 0.29%, NASDAQ climbed 0.30%, although we were much higher most of the day. This feels like one of those moments where the bulls are trying to have it both ways on a bunch of key issues. That's not good. Some things are mutually exclusive. Today was a good-looking day that was actually quite ugly. Yes, the inside didn't look like the outside. And you know I don't think you should judge a book by its cover. I know hope springs eternal, but today we saw too much hope. Too much hope springing eternal. And some of these hopes simply can't be reconciled. So they won't work in the end. What do I mean? You can't have the bank stocks keep going up while the financial tech stocks also go up. It's either one or the other, because portfolio managers only go all in on fintech when they're scared to own the banks. You shouldn't have a rally in old tech coupled with a rally in new tech. That doesn't work. They tend to trade in opposite directions. And the biggest contradiction in today's actions, you had the soft goods stocks running right alongside retail. The soft goods stocks are recession plays. The retailers are economic expansion plays. You see how that's problematic? So what is going on here? Where the heck did the rotation out of one and the other go? Why is it that the only pure play industrials were able to buck the upward trend, and only because several of them actually gave downbeat analyst presentations today? It's simple. I know the answer because I've been around for a while. Somebody's wrong. This market's presuming that things are good everywhere, and I know that's not going to pan out because it never pans out that way. Let me explain. For a long time, this market's been hemorrhaging money. Individual investors have left this stock market in droves, hiding their money in bonds, seemingly at any level. In many ways, stocks are still a discredited asset class, even as the average is doing pretty great. These days, the marginal buyers tend to be pension funds, individual investors buying index funds for retirement, or companies repurchasing their own shares. Who can blame them for staying on the sidelines? Stocks do trade erratically. There's no consistency whatsoever, and we've now rallied for 7 straight days, a pretty long winning streak that usually means the buyers will soon be exhausted. More on that later. The lack of new capital coming in means we often get whippy rotations, where money flits around from one sector to another, depending upon whether the interest rates are going up or going down. But not today. Today, nearly everything rallied. And look, while I'd love to believe that the reason why that is because there's a tsunami of new money coming into the market, driving everything higher, the statistics say otherwise. In fact, we're experiencing one of the largest migrations from stocks to bonds in ages. No wonder a big IPO that came today, Smile Direct, could be one of the biggest first-day busts in years. If you bought at the opening, you got hammered. Which brings me to the real explanation for the all-too-rosy scenario. I believe that some of these groups of buyers will prove to be just plain wrong, and once the smoke clears, they are going to likely lose a lot of money. First, let's talk trade. Right now, buyers are under the impression that we may be having a thaw in our trade war with China because President Trump extended a goodwill gesture by pushing back the next tariff bump by 2 weeks, so as not to coincide with the founding of the People's Republic. Think of it as a birthday present. In return, last night, the Chinese said they'd be willing to make an interim deal on trade if the White House would be willing to separate purchases of goods from their other more serious demands, like intellectual property enforcement, getting rid of those bogus joint ventures when they make our companies join forces with local partners so they can steal our ideas. Sounds good? Just one problem. It's a complete misread of the situation, once again, by the Chinese. They just don't get it. Well, I think China may be offering something substantive. You've got to remember why President Trump started the trade war in the first place. It's because we've been getting kicked in the teeth for years. See, initially he was focused on the trade deficit. If the Chinese Communist Party, I believe, had simply stepped up and bought a lot more goods from the United States, they probably could have nipped this whole thing in the bud, but they didn't. Now the president's digging at his heels, insisting that China addressed all sorts of inequities, the stuff that really matters as far as I'm concerned. And that's why the Chinese response to the president's 2-week reprieve is so tone-deaf. We're way too late in the game for him to be appeased by a soybean pie, for heaven's sake. Chinese, what are you thinking? A story floated earlier this morning that the president may want to do deals soon was erroneous, according to my sources. The truth is, without some concrete change in China that undoes years of unfair practices, don't get your hopes up. So the people who think we're close to a trade deal, people who are buying lots of stocks that benefit good relations with China, I think Apple, Starbucks, some of the semiconductors, they're going to be disappointed. That's what I'm betting. We're seeing something similar in the bank and the fintech stocks. The people buying Bank of America and JP Morgan are betting that the economy is going to get better, which will cause long-term interest rates to rise and make the banks more profitable. On the other hand, the people buying Visa, MasterCard, PayPal are wagering that the economy will weaken, rates will come down, and you want to own the secular growth stories that can still hit their numbers in a slowdown. Someone's wrong. I suspect the buyers of the big banks could be off base, because I don't see much to indicate that we're really getting a stronger economy. For that to happen, the Fed needs to cut rates, and they need to cut them big and soon. And that would give us the boost we need. But I fear Fed Chief Jay Powell will want to be measured. He'll say we need to see further slowing before he cuts again when the Fed meets next week. Plus, it probably doesn't help that the president does keep calling the fella a bonehead and demanding that he cut rates aggressively. Don't get me wrong. We absolutely need lower interest rates. The president is dead right. We're totally out of sync with the rest of the world. Europe has sub-zero rates, for heaven's sake. That is not a refrigerator. But you catch more flies with honey than vinegar. Vinegar's good for descaling the Keurig, by the way. So I'm not sure Trump will be able to convince Powell to do what he wants. At the end of the day, either the Fed cuts or it doesn't. They can't do both at the same time, right? I'm betting they'll be too cautious, which means the buyers of MasterCard and Visa are right, and the buyers of the big banks, no. Then there's the retailers versus the consumer packaged goods place. We buy the former when the economy's humming. We buy the latter when the economy's stalling. In this case, I'm betting both sides are wrong. I feel like the retail stocks have had much too much of a good thing here and need to be trimmed. And the consumer packaged goods stocks are way too expensive versus their historical valuations and need to be trimmed. Finally, there's old tech versus new tech. Old tech is typically about supporting personal computers and cell phones. New tech is about the cloud. Old tech's rallying on the hope that we'll get a trade deal sometime soon. You know how I feel about that. New tech's taking off because these stocks have been hammered, and now the sellers are exhausted. Plus, the cloud plays keep reporting good numbers. I trust the cloud. I'm suspicious of the cell phone sales. And frankly, I wasn't crazy about the numbers from old line semi Broadcom this very evening. One exception. This remarkable rally in Apple is all about the watch and the service revenue stream growing to the point where they can smooth out the company's sales of handsets while having margins go up and earnings per share increase. Still, even the stock of Apple, and you know I always say the same thing. What do I say? Repeat after me. Own it, don't trade it. Even the stock of Apple deserves a breather after a truly remarkable run, $1 trillion company. Bottom line, in all these cases, it's possible that both sides could be right, that I'm too negative. At the same time, though, while it can happen briefly like it did today, you know what? In my experience, that never lasts for long. And it usually doesn't end happily ever after. I need to go to Casper in Oregon. Casper.
Happy Thursday, and thank you for all you do for those of us who learn so much from you.
Oh, Casper, you're terrific. Boy, did my daughter love her stay in Oregon. She's moved on, but wow, what a beautiful place.
It is, and I also want to let you know I watch your show every day, and if I can't be home to watch it, I make it a point to record it. I do not miss you at all.
I love it. You know, we get it. We've been the show's been around a while, so to hear that is the great verification that it's got to continue to be around for a while.
Oh, and one more thing before I get to my question. I know you want me in a hurry, but I'm also amazed at your energy. I'm a late nighter as well. Before I go to bed, you're on talking about how the stocks are moving that day. Early at 5 and 6 in the morning, and then at the end of my day, you're there telling us how we can get some mad money in our bank.
Oh, you're terrific. Thank you. Hey, by the way, Speaker of the House Nancy Pelosi has the same hours. I didn't know that. Same hours. Okay, let's go to work.
All righty. In April, I am a chocoholic. I love everything Hershey. So I've got Hershey stock in April, added it to my portfolio, and it's gone up. Then it went down. Then it went down. Then it went down. Then it went up, down, down. And it's just like down again. And I can't figure out what's going on with Hershey. And I read that there could very well be soon a shortage of cocoa.
Yeah, there is.
Now,
There is. There is. Now, here's the problem.
Should I cut the fat out of my
No, long term it's great,
down?
but the stock has moved up way too much. And I've got to tell you, as much as I believe in the company, there was a downgrade today by Sanford Bernstein that made a lot of sense. All the big money that can be made in this, I think, has been made. Where have you been all my life? Wow. And thank you for the kind words. Nate in Colorado. Nate.
Jimbo, what's going on?
I don't know, kind of typical day, doing a little fantasy. How about you?
Same old, same old. Hey, I heard your segment yesterday on the retail stocks, and I was shaking in my boots a little bit. But I got a question for you on Tailored Brands, TLRD. And they're not part of the LBO or private equity space that you warned about yesterday, but want to hear your thoughts.
You got to stay away. I mean, a lot of people were in it for the dividend. I think that they are. This is. I don't want to call it a disaster. Let's just call it a something you should not own. And dude, it was really remarkable how bad it was, frankly. And just please don't go near it. All right. All right. You can't have all these contradictions. This is not like. But it's not like Engels, okay? You're Marty or the other guy. One side has to be wrong. This action can't last for too long. On Mad Money tonight, CrowdStrike is down nearly 25% over the past month. Is that a red flag or a prime time to strike? I've got the exclusive with the CEO. Then it's a pretty decent moment for stocks, but I'll tell you why I think twice before I'd be buying into the end of the day weakness. And the retail apocalypse doesn't seem to be dying down anytime soon. So why is retailer Everlane opening a brand new, beautiful store in Brooklyn? I got a chance to check out the space, speak to the CEO, find out what sets the private player apart. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.